Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi and welcome to another episode of Capital Minds podcast. Today, we're going to have a very interesting discussion around a subject we know very little about, to be honest. We've got a lot of numbers, but putting them all together has been quite fascinating even for us. It's about this behemoth called Life Insurance Corporation of India, or LIC. And Aditya and me are going to discuss about the various aspects of this very large insurer that India has, and the fact that the government has announced that at some point in the future they're going to list it on the public markets. So we're going to take a look at the numbers, the market, the size of this company in comparison with all of the other players out there in the financial services space, and perhaps give a small inkling of what we think the IPO is going to look like. So firstly, welcome Aditya to the show and let's get it going.
Hey Deepak, amazing to be here. So it was really exciting for me when I was collecting the data because, LIC is very opaque. And since it's not listed, most of the data is not available. So I had to look for public disclosures and the annual reports. But as you rightly pointed out, it's a behemoth. Just look at the numbers. Like LIC manages about 30 lakh crore in the life insurance sector, like 30 lakh crore, and has an annual premium book of over 3 lakh crore. And it holds 76% market share in new policy issues. Now, let's take a breath to absorb these numbers. Like, these are amazing set of numbers. For example, look at the AUM. Like, they are managing around 30 lakh crore. The entire AUM of all the mutual funds in India combined is what? 26.5 lakh crore?
That's about roughly 26, 27. So that's the number.
And then I was looking at the commission LIC pays. So I'm just throwing some random numbers. Guess what would be the commissions that LIC pays to its agents? It's 19,300 crores per year. And the salary is 19,800 crores. And the employee cost is 48,000 crores. This is insane. Like TCS pays 50,000 crores. And here is LIC paying 19,000 crore as just as commissions.
I think, where you are is also the fact that these guys have been in existence for the longest time. They're probably the only insurer until insurance was thrown open to the private space. Even today, the largest insurer is LIC. It collects about 3,80,000 crores of premiums. 3,80,000 crores is probably more money than flows into mutual funds added up in the entire year. So
yes,
that's one way to look at it. They manage more money than all of the mutual fund companies put together. The second largest life insurer is another public sector company called SBI Life,
correct,
which collects about 93,000 crores, 1/4. They are 4 times as big as the next competitor. HDFC Life is probably 4th in the game, about 58,000 crores or something like that. And then, so that's like saying the private insurers, ICICI and HDFC in that order, are a fraction of LIC's size in terms of both new premium collected. And remember that the growth of LIC's first new premium, or actually total premium collected, is over 10% a year. So they grew from a 320,000 crore premium collected in 2017 to in 2019 they made about 380,000 crores. So that's about 60,000 crores, roughly 20% in 2 years. So they have been growing at that pace.
even at that base.
And at that base, because if you look at the fact that even an SBI Life has gone up from 60,000 to 90,000. So in the same time, SBI Life was able to collect 30,000 crores in 2 years, whereas LIC was able to collect 60,000 crores in 2 years. I mean, I understand the bases are different, but when you're talking about total premium collected, you're roughly looking at these extremely large numbers, right? I believe they have one of the largest renewal premiums as well. So they've got a fairly large tick of renewal premiums. They have a very large tick of single premiums. First year, I mean, it's just the numbers are mind-boggling when it compares to pretty much anything else we see on the investment front, apart from maybe fixed deposits, which are probably the only real comparison that you could make in terms of the same size.
And just look at the individual assurance policies in force. So LIC has 28 crore individual assurance policies in force. Now let us compare that to total folios. It's around just 8.5 crore, right? And the demat account, another like 3.65 crore. So again, here, like these numbers are huge.
Yeah, I mean, if you consider also that many people have multiple policies, like they have multiple folios. If you consider that each person has 4 folios, that's 7 crore people. There are 5.5 to 6 crore taxpayers in the country in FY19, maybe 6.5. Roughly, for every taxpayer, we have one policy holder in LIC. So it's literally saying they own the insurance space. And probably the all of India's financial services place, because nobody else has this kind of penetration. The mutual fund companies added together have probably less than half of this. So there is a substantial size difference here.
Seriously, like this is some sort of an achievement. So let us try to understand the basics of the business model. So there are two kinds of traditional products, right? Non-participating and participating. And then there is also market-linked and non-market-linked plans. So could you please explain us what is participating, non-participating and the other stuff?
Yeah, so I think one of the things that happens is if you take a term policy, right? If you die, they give you a premium and then they give you a certain amount of money. This is a non-participating policy. You don't get any money back if you don't die. This is a pure term policy.
Okay.
Does not participate. When I say participate, it means if the LIC policy holders put together make a profit, a part of that profit is paid out into the policy holders account.
Okay.
And that part then corresponds to the kind of bonuses you will get, and therefore a participating policy will get these. Now, typically you might have heard of policies called money back.
Yes.
Or endowment.
Correct.
The idea of endowment or money back policies is that they participate in the profits. So they might actually tell you, listen, you'll pay a 1 lakh premium and we'll give you back 15,000 after 5 years and another 15,000 in 10 years and something. It's almost like you pay them and they give you a premium back.
Okay.
But at the same time, they'll say at the end, there'll be a big bonus, and that big bonus will kind of make you decent returns. The returns actually add up to just 4.5% or something. It's not even better than a bank deposit. But a lot of people find that useful for being a forced saving. There's some tax saving that used to exist in the early years, may not quite so in future years. But the important thing to understand is about this participating, non-participating point is about how much LIC chooses to share with them. Of course, there's a certain limit amount that it has to, I think 5% or so. But
okay.
It doesn't necessarily, I mean, you're left at the mercy of LIC to choose how much your policy will get versus some others. And then there's also the fact that there is linked and non-linked. When I say non-linked, it means if you buy a policy and then it's a non-linked policy, a typical endowment policy is not linked.
Okay.
An endowment policy that is not linked will say that they will offer you a certain sum assured or a return or a bonus that's actually not linked to the performance of the investments made with your money in order to service the policy. So you give an insurer money. The insurer can say, listen, I'll pay you money if you die.
Okay.
But if you don't die, I'll invest the money so we'll earn some return and I'll share some of that returns with you.
Okay.
So that is your endowment non-participating, participating non-linked.
Okay.
When I say non-linked, it means they won't tell you exactly what they bought with your money. They'll just say, listen, we'll give you some bonus. It's based on overall profits of the company.
So when you say non-linked, does that mean that if they incur losses, I am not at all bothered? They're still going to pay me from their own pocket?
Yes, not from their pocket. Well, there won't be any bonuses to distribute, but they take into account the fact that over a long period of time, because most of their money is going to be invested in debt securities, and perhaps a large percentage percentage in government bonds, there is unlikely to be a default of that kind of size that will overshadow the kind of returns they make just from their government safe policies.
Okay.
So if you for instance invest 90% of your money in one sort of investment which gives you say guaranteed 7% a year, that means you're earning 6 rupees 30 paisa just from that 90%. So to lose 6 rupees 30 paisa from the remaining 10%, you would have to lose 63% of your
Correct.
which is unlikely. So what happens is that profit pool therefore is likely to be smaller if there are losses but larger if there are profits. So the sensitivity to the profit may not necessarily take the profits to below zero. And even if they do go below zero, there will not be any loss to you. Of course, you won't know it because you'll get paid after 15 years. Over a 15-year period, unlikely again that you will see a loss. So in whatever it's worth, there is no loss transferred to you as a policy holder. Whereas in a linked portfolio, what they will do is they link your investments to link your money, your premium, to a fund which is actually investing in certain set of market securities. So maybe equities, maybe bonds, whatever. So those bonds go up or equities go up, you make money. And you make as much money as your investment is, as is bought. And if it goes down, you actually lose that money.
Okay.
So the LIC itself does not take that risk.
Okay.
Therefore, LIC does not profit from that fact. They only charge a management fee, and they can charge that management fee in any case. But they don't necessarily, they don't participate. The LIC does not participate in your profits. So in a linked policy, you are a participating policy holder to the extent that LIC does not participate.
Okay.
In a non-linked policy, you could be participating, but LIC will also participate.
Okay.
Right? So there's
I get that.
difference between the two.
And Deepak, I was looking at some competitors such as HDFC Life. So I noticed that LIC has the highest dependence on non-linked products among Indian peers. So the dependence for LIC is 98%, whereas for HDFC, it's a clear 50-50 mix.
This is also because of the vintage of the company. So the company has existed for the longest amount of time. For the most time, it invested only in government securities, and therefore it sold largely endowment policies. These are non-transparent policies. You didn't know what kind of bonuses you're going to get. You're left to the mercy of LIC to decide at the end of the year what bonus you would get. Now, linked products came into vogue only recently, and what happened? When I say recently, I'm talking 10 to 20 years ago. So roughly, the private insurers embraced that much more because they didn't have to take the risk on their own balance sheet. Their balance sheet was not strong enough to take a large amount of risk.
Okay.
So they had to pass the risk over to the policyholder. Right? Like you said, if they invest in equities, the equities fall. Now, an LIC can take that risk because it's saying, listen, I got a very big balance sheet. So if it falls about 10-20%, I'm fine. Whereas these other insurers didn't have that kind of a deep balance sheet. So they would always go in and say, listen, we want to offer you a better return, but we can't guarantee that to you because you don't have the balance sheet to do it. So why don't you take a linked policy instead? So a lot of the other companies went more linked. It also has to do with commissions. There are a lot higher commissions in linked policies than there are in unlinked. There's a lot more demand for linked policies in urban areas than there are in rural areas.
Okay.
Rural is where LIC is very strong. Urban is where the other insurers have some kind of leeway. So people in urban areas will understand linked policies better. They understand the ability to take a loss. The rural consumer is not one of those guys who will find it very nice to lose money no matter what. And LIC is always given that feeling of if you're with LIC, you won't lose money. Therefore, they've always sold or pushed their people to sell endowment kind of policies,
Correct.
non-linked policies, which have been a substantial amount. Of course, in the middle, they also saw their linked policies go up, but it's nowhere compared to the size of the non-linked policies that they have.
So Deepak, I have pulled the claims data for 2018 and 19. Maturity is the highest component of the claim data. It's about 1.5 lakh crore. Second comes the surrenders. Third is death. So clearly death, which I believe is the lowest margin product, has the second lowest composition to the claims data. Whereas maturity is 1.5 lakh crore, and I see a lot of murky products here, isn't it?
Yeah, so what has happened is India has traditionally been this nation where agents have gone to people and said, why do you want to take a term policy when you can take a policy where you will get your premium back if you survive? I mean, bachega to kya milega? So the idea is that everybody says, oh, well, you know what? If I die, you'll give me money. You'll give my family money. But if I live, my premium is gone, right?
Correct.
So to solve this, people go and buy these crazy policies. Now the difference is like this. If I were to take a insurance policy that is giving me a 1 crore worth of insurance, for a policy might actually cost me something, an insurance policy from LIC might actually cost me something like 25,000 rupees per year.
Okay.
The same policy where they'll give me my money back with some bonus, some 4%, 3%, something kind of return. Sometimes they'll just give me whatever I paid, only that much back. That policy will cost 1 lakh rupees. It's literally 4x. That's a simple concept. It cost me 25,000 to insure you, right?
Okay.
Well, 25,000 minus the commissions, maybe 20,000 or maybe 15,000, some number. That number is required to insure you, because if I insure you at 15,000 rupees per crore, then I should insure maybe 600 people like you. So 1 in
Correct.
600 will die. And 1 in 600 I'll pay out. So, or I assume that less than 1 in 600 will die. So I will make some money out of the fact that, let's say 1 in 1,000 dies. If 1,000 people have paid me this 25,000 rupees, have paid me 2.5 crores. I pay out 1 crore, I make 1.5 crores as
Correct.
roughly as a profit on that year. So if 1 in 1,000 dies, and of course, if more die, then I have a problem. If less die, then I make a profit. So it's always an actuarial game over there. But in the case of a policy where they give you your money back, where there's a maturity value to the policy, which means at maturity you will actually get something. What do? They take your 1 lakh rupees of premium, put 15 or 20,000 rupees as against the policy to be kept in case you die.
Okay.
They invest the remaining 80.
Okay.
So the remaining 80 over a small period of time, 80 will become 100. If you get 5% a year in 4 years or 5 years, it will become 100. So if you survive the policy, which will typically be a 15-20 year time frame, that 80,000 which they have taken from you will actually become probably 1.5 to 2 lakhs. They'll give you 1 lakh, they'll keep 1 lakh as their profit, and everybody's happy. You think you got your premium back. Whereas what you don't realize is the equivalent term plan cost you 1/4 what it would have cost you to get your money back.
Correct.
And therefore, if you ask a person, I want my money back and I have only 25,000, they will take a policy whose assurance value or insured value
Would be very less.
Would be 25 lakhs. So 25 lakhs is not enough for you. If you're going to pay 25,000 rupee premium, 25 lakhs is not enough. But if you pay 25 lakhs for a term premium, 1 crore is what your assured value is, which is so much more better. So it's really a function of how badly designed products actually appeal to investors simply because you use terms like I will get your money back. So you always appeal to that irrational sense, which is semi-rational in a way, of the investor. And that's why maturity proceeds even today for LIC are the largest chunk. As we go forward, we'll see probably where death claims will become higher and higher and higher as a percentage as people start to realize the value of term plans. But contrary to popular opinion, death plans are actually more profitable as a percentage basis to LIC because India's lifespans are increasing. We're talking about India's lifespan being 35 in 1950 to probably around 75 today. Every 10-year plan, India's lifespan increases by between 3 to 5 years.
Okay.
I'm sure in 2021, when they do the census, they will find out that India's lifespan has increased to 78 or something like that. So over time, if people live longer, they are paying premiums for longer. Sometimes their policies are getting matured before their premiums, before they die. So in a lot of term insurance, you basically pay premium until the guy has a term. So if he has a 30-year term and he lives 30 years, you don't have to pay anything back. So your term plans are actually more profitable as India gets healthier and as people live longer almost naturally. So to give you, a crazy example, you in a term plan, you actually, people, neither the individual, your customer, nor you want to see this plan paid out.
Okay.
Because I don't want to die. I don't want to die just because my relatives will get wealthy, right? So it's a stupid assertion now, but you have now me also working towards the goal of not dying. And LIC also being happy that I am working on. So both of us are winning, except
Obviously.
LIC is making the money out of this. And the more healthy I get, the happier LIC is. So at some point in time, they'll start offering things like, oh, did you do this checkup, health checkup? I'll give you some extra this thing. They're doing it already in health insurance policies, not LIC, of course, but other insurers, health insurers. But life insurers soon will start getting into that act as well. But you have to think about the fact that the mix today remains largely maturity.
Correct.
A good part surrender. So 1,50,000 crores is maturity value payouts. Surrenders are 70,000 crores, which means people have gotten these products and then they've decided that this is a bad idea for them or that they need the money urgently. They've surrendered the policy. Every surrender is a profit to LIC.
Okay.
Because what happens when you surrender the money is you surrender a policy. Typically, policies are badly designed. And therefore, when you surrender a policy, they'll give you only 30, 40, 50% of the amount that is available. So many people surrender in the third, fourth, fifth, sixth years of the policies or try to surrender in those years. The payouts typically end up enriching LIC. So when you have a 70,000 crore surrender, consider the fact that this is probably 100,000 crore surrender, out of which they paid out only 70. So 30,000 crore just went as profits to LIC. Of course, they don't show it that way. This goes as parts of the profits of a profit pool that might eventually be used later to pay for other calamities. Like today, you have a coronavirus. That coronavirus gets big in India, a lot of people are going to die.
Okay.
LIC is going to have to pay that out. LIC then takes some of this profits that it earns from surrenders and all that stuff and keeps it as provisions just in case such crazy situations arise. Until now, LIC had to answer to nobody except its own masters, which is the government of India. The government of India doesn't care if LIC makes profits or not because either ways it's not paying any taxes as a policy, as an insurance company. So therefore, they don't care whether these profits sit in provisions or not. There will be some income tax component at some point, but there is not so much available now. So there is actually now a significant amount. So if you look at the total payouts that they do about 2,50,000 crores.
Correct.
They earn, like I told you said before, the total premiums they earned this year were 3,81,000 crores. So you earn 3.81 lakh crores. You spend 2.5 lakh crores. Earn 3.8, spend 2.5. You've literally, on a cash flow basis, made 1.3 extra.
Correct.
Of course, that has to be invested, but 1.3 extra. Out of that 1.3 extra, you've used some money to pay for salaries. Like we talked about, 50,000 crores roughly.
Correct.
So 130,000 crores was your excess premium collected. 50,000 you paid in salaries and commissions and management expenses. You still have an 80,000 extra money that's floating around.
Correct.
They go and put that into a buffer as provisions and leave it. But roughly this 80,000 crores is just simply excess premium. You don't actually need all of it to be put as provisions. You might be able to sequester a significant part of it, maybe 10,000 crores, maybe 20,000 crores, but a good portion of that can be taken out as profit. This profit pays for, this profit is what LIC would have actually been earning.
Okay.
It's difficult because the books don't show it that way. But you need to look at deeper numbers in order to surface the actual amount. But roughly speaking,
And these are just premium incomes, right? We also need to look at the other income and income from investments. So that brings me to the next section where we talk about investments made by LIC. Now, when I was going through the public disclosure of LIC, I came across a word, approved securities. So I searched for it. So basically, IRDA has a rule where LIC or any other insurer is required to invest the bulk of its policyholder money in approved securities, which are basically central and state government bonds and highly rated corporate bonds. Okay. So LIC has invested about 20.6 lakh crore in government bonds. Like amazing, right? So what would be the total size of the government bond market in India?
So, just look at the central government borrowing. It's about 60 lakh crore outstanding as of date. I think 15 lakh crore of that is held by LIC.
Oof.
That's like 25%. Now think about the fact that LIC is so big that it takes 1/4 of every government bond issued and puts it on its books.
Amazing.
So that's the size of this market. This is greater than all the so LIC is probably like the second largest player after banks. Banks as a whole probably own maybe 32 lakh crores of the Indian government bond market. 15 lakh crores is held by LIC alone, so 47. The rest is mutual funds, other insurers, pension funds, and so on, who are regulatorily required to own a certain amount of
Government security.
government security. So LIC is therefore one of the largest players in the government bond market per se. Also, there, like you've noted, if 15 lakh crore is central government bonds, what is the rest? It's probably
State government, correct.
So state government bonds also now a significant player happens to be LIC. It's simply that if state governments wanted to issue, they were not financially savvy. They asked LIC. LIC said, whatever. And, they would go and buy these bonds of state governments, which leads us to some interesting discoveries there as well, right?
Correct, yeah. So I just noticed that few state governments such as government of Jharkhand, Chhattisgarh and Assam, they have defaulted on a few minor like bonds. The total would be maybe a few crores. So it means nothing, but it's not that the government of Assam cannot pay 5 crore rupees to LIC, isn't it? But it's LIC, it's a cash cow.
Yeah, I think sometimes defaults are pre-planned, saying who takes the risk. And many of these are much earlier, done at a point where 5 crores was actually a reasonable number. But having said that, since in recent times, I think we've not had any major defaults other than maybe a few small road projects or SPVs or something like that, which have been isolated, where they've actually seen some kind of a default and the LIC has taken provision. Now, roughly added all up, it's only 32,000 crores in total NPAs.
Correct.
If you add everything up, including the fact that they invested in DHFL, they invested in this, they invested in that, 32 lakh crores of investments, out of which 32,000 crores are NPAs. That's 1% NPAs.
Correct.
That would be a bank I would want to buy because, if you have a bank who's got only 1% NPAs at that size, you want to buy it. Because even in ICICI has 4% gross NPAs. And these are gross because LIC is provisioned for all of these losses for the
Correct.
most part.
Yes.
Only a very few of them are at 25% or 50%. Everything else is 100% provisioning. So if you've got 100% provisioning, you've taken the loss on your balance sheet. It no longer appears on your balance sheet as a loss. So you've set it aside as 100% provision, which means if you had to lose money, you've already lost it.
Correct.
That means only new incremental NPAs will hurt you. The old ones will not, because if you had a 25% provision, that can go from 25 to 100 and hurt you. So if you have very little that's sitting at 25 or 50%, then the chances of your old NPAs hurting you is relatively small. So essentially you got a bank with 1% gross NPAs and 0.1% net NPAs. Put it another way.
Correct.
That is actually a very interesting proposition because this is a very mature financial institution in that respect, and they've managed to diversify substantially well. And even though they've had defaults, even from state governments, they've managed this process quite well.
Talking about proposition, as you said, this brings me to the IPO. So as the government said that they're going to list LIC, so how should one value LIC? And
That's interesting. We have got LIC owns a significant amount of the market itself. It
Correct.
owns 4.7 lakh crore.
Yeah.
Now, 4.7 lakh crore is roughly, half the size of Reliance. It's got that much of securities. It owns 34 of the top
they have stake in 34 out of 51 Nifty companies.
Nifty companies. They own a bank, IDBI Bank.
Correct.
They own a housing finance company called LIC Housing Finance. They own a mutual fund called LIC Mutual Fund. They own real estate assets in almost every town in India. They have a franchise that goes from probably the western tip to the eastern tip and the northern to southern. You can find LIC agents everywhere. So you've got all of this to value. How do you value this? I mean, you don't know. You can take the sum of the parts. So let's say the real estate valuation is X and that valuation may be 50,000 crores. I don't know. I don't know the numbers because they haven't come out with the IPO numbers yet.
So if you look at their investments, so they have made investments in real estate of about 1 lakh crore. So 20.6 is in government debt. 4.7 is in equity, and they have 2 lakh crore in other approved bond, which I'm assuming would be AAA corporated bonds, and then they have 1 lakh crore in real estate.
Yeah, there 1 lakh crore in real estate would be at the price at which they was purchased. So in Bangalore, for instance, they have an iconic office, a couple of them actually, one near the town hall and one on MG Road. These buildings alone are probably bought for less than maybe 10 lakhs, because this was bought many years ago.
Correct.
And today they will be valued at probably tens of crores or hundreds of crores.
Correct.
In that way, they've got Delhi, they've got Bombay, they've got other places. So the real estate portfolio alone may be worth more than 3-4 lakh crores. I don't know the numbers yet. So that is one part of the whole game. Then you've got the LIC Housing Finance stake, the IDBI stake, the LIC mutual fund stake. All of these have a certain value. And then on top of that, you've got the base business itself. If you're earning 3,81,000 crores of premium every year and you're paying out 2,50,000, and you're keeping a little bit here and there for everything else and salaries and so on, you actually have a business where your costs, so roughly if you look at the total AUM, which is 3.2 lakh crores. Now premiums are one thing, 32 lakh crores. And then you've got an asset management fee that comes out of the current, so every year out of that. So let's say you can extract out 0.5% or 1%. So just looking at the fact that I'm managing 32 lakh crores of AUM and I can get out maybe 0.5% to 1%. Of course, unless you can get much more, I'm just saying. Plus you're getting an additional 10% of that every year as premium, or 10 to 15% of that. So you're growing at 10 to 15% a year. You are in a business that says I am currently earning just as premium, the asset management fee on my insurance. I'm probably earning roughly 50 to 60,000 crores a year, 1 to 1.5%. I mean, 0.5 to 1.5%. At the upper end, I'm probably earning 60,000 crores. I'm going to spend about 45,000 crores. I have other actuarial expenses and, things to be kept aside. But I also have the fact that I make a lot of profits from policies that surrender early, that have a certain termination fee, that I don't have to share all my profits with my policy holders, of which substantial amount come in through participating but non-linked plans. So my earning capacity is probably a revenue. If I looked at it traditionally, it might be a revenue of 70,000-80,000 crores a year, of which I might profit maybe 10, 20, 30,000 crores. If I'm profiting at about 20,000 crores, and I were looking at it as a PE perspective, I would say 50 times earnings.
Okay.
That's 10 lakh crores. 50 times earnings is ridiculous for a company of the size of LIC. So take 10 times earnings at the lower end, you'd end up with something like 2 lakh crores. So now you've got a very wide valuation game between 2 lakh and 10 lakh. All other Indian insurers are valued at a multiple of embedded value.
Correct.
LIC does not declare its embedded value. We don't know what its embedded value is. So roughly some people have said it's 25,000 crores, but I think that's too less. It's probably of the order of maybe 75,000 to 50,000 to 75,000 crores. So if you take it as a multiple of the embedded value for the core insurance business of 2 times or 3 times. So you're talking about 2 lakh crores is a core valuation of the business. Properties may add up another 2 to 3 lakh crores. So you're talking 4 to 5 lakh crores. So I think this is one of the largest companies in India to list, if it does. And you'll talk about a base valuation of around 5 lakh crores. Assuming that the properties are actually owned by LIC and not by the government. Assuming a lot of things that we don't know anything about because we haven't seen a DRHP. Assuming also that the LIC Act has to be amended suitably. Remember, LIC actually doesn't make any profits. Okay, it puts everything back into the pool.
Okay.
It doesn't have to declare profits. So tomorrow, as it corporatizes, it may have to declare a very different set of books compared to what it does today. So when it does that, we don't know how the numbers will change. So if you're taking 4 to 5 lakh crores, of which the government will probably offload only 10 to 12%, there will be a substantial premium for the float, because everybody will want to buy LIC. Remember, it will go to the Nifty. It will go into all of the largest set of companies in India. So everybody's going to want to buy it. All the institutions, the mutual funds, the ETFs. Pension funds, the ETFs from abroad, they'll all want a piece of this pie. If they all buy a piece of this pie, the amount of available for trading will be probably very small, 2-3,000 crores or so on. If 2-3,000 crores is all there is to be traded in a company worth 5 to 7 lakh crores, what's going to happen? The price is going to shoot up the way IRCTC does, the way some of the other companies do, simply because there's a low float. So you're going to find that the IPO will find the company, make the company very attractive. And at some point it'll fizzle out because it's a government company in the end, and it's not designed to make the best for the shareholder.
Correct.
It's designed, of course, to make the best for the ultimate shareholder, which is the government, but not necessarily for other shareholders. So I think it's a very interesting play. I think valuation-wise, we'll see what eventually comes out. I may be pleasantly surprised to hear that there's a much larger company than I thought. But I also feel that we could be disappointed in seeing that this company actually has much lower earning potential than we think it does right now.
Okay. I hope we do another podcast when the IPO actually comes out.
This is awesome. Aditya, we've had so many fun discussions, and I know that LIC has been a topic that's just come out because the budget announcements came in. And what surprised me about this whole thing was the size. It's like comparing India and China, right? Sometimes you say, oh, India and China, same breadth. But then you look at China's numbers and you say, can't be same breadth. Similarly, LIC compared with any other financial services firm that's in the investment or insurance space is literally like comparing a very big giant to a pebble. It's just not possible to imagine the size of this company with everything else, the tentacles it has all over the place. I don't mean tentacles in a bad way, but I'm just saying. Also to the fact that there are so many people buying its products, despite us and hundreds of other people having written on the internet that some of these products are not the best in terms of returns, in terms of assurances, guarantees. You could get better products elsewhere. It doesn't matter. To these people, LIC is one of the best, most stable companies in the space. It's quasi-guaranteed by the government of India, and it will continue to hold its shine. So even if they pay more or get less returns, the safety, the attraction of it is so strong that you would look at this company and say, if it were a public listed company, I'd want to own it.
Correct.
Simply because it has that brand. Now, it is coming for an IPO. We don't know when. It will hopefully happen in our lifetimes. And in our lifetimes, we'll get to see that DRHP and admire the money-making ability of this company in this behemoth that we are seeing in this space. And like you said, let's do another podcast when that happens. So it's been wonderful, Aditya, having you on the show, and we've been doing a lot of these discussions. Wish you the very best. And we have a great set of people listening in. Throw us your comments at capitalmind_n. I'm at Deepak Shah. Aditya is at Astute Aditya. We're always happy to hear your feedback, questions, clarifications, and do visit capitalmind.in for our commentary and our opinion pieces, and capitalmindwealth.com, where we, as a very tiny asset manager, manage a certain amount of portfolios in a relatively low cost and efficient manner. So glad to have spoken, Aditya, and lovely to have you all listening. Thanks for listening.
Thanks a lot, Deepak. Thanks.